Thanks for joining us, everybody. I am here today with Rob Paynes and Matteo Virilli, and we're here to talk about the equity markets in general, and of course, how MBP portfolios have been reacting to what has really been a very unusual year in the markets. Maybe I'll start with you, Rob. Can you just give us a high-level view of how the markets have behaved this year and what your view on them is?
Yeah, it's a good economic background in terms of earnings growth. Despite a lot of uncertainty on the southern border, with the economic policies there, we're still seeing strong earnings growth out of the companies that we follow, out of the market in general. Balance sheets are in good shape. So basically, a pretty good economy. We have seen both in Canada and in the States. Um, Somewhat narrow markets, which we've seen before, in the US, largely driven by technology, all of the noise around AI, which I'm sure a lot of it is justified. And in Canada, resource stocks, particularly golds. And so we've seen a much narrower market than we've seen over the last few years on both sides of the border.
So would I take that to say that certain sectors are responding more to those largely good earnings reports than other sectors are?
They are. What it's done though is it's driven a lot of the stocks in those sectors to unusually high valuations, and in a lot of cases, valuations that we're just not comfortable owning.
Right. Right. And everyone will have heard either me or the media. You can't get away with hearing about the Magnificent Seven. I think it's seven now. Sometimes it's eight and ten, and but
Yeah.
let's call it these mega caps. Matteo, you were looking at some of the how much of the overall market return that these companies have commanded. Have we seen like a lack of dispersion, concentration like this in a long time?
Yeah, for sure. I mean, if you peel back the onion and you look at a couple of layers into the market return as a whole, sure, the market has done very well in the US. I think we're about 17% year to date.
Hmm.
But if I look at the middle stock, so, there's 500 names in the index. If I go to number 250, the return there is only about 5% year to date, which is,
Right.
quite staggering when you look at the difference. More importantly, if I take the top five names that have contributed to the performance in the index, they have contributed about half that return. So 8% came from only five stocks, and they had a weight of about 20% of the index. So speaks to, very much concentration in the index. And there are a lot of those Mag 7 names that you mentioned, NVIDIA, Broadcom, Microsoft, Google. That's where a lot of the contribution has come from. As a whole, it's probably technology that's contributed about 10% of that 17% return. So again,
Right.
it speaks to the concentration in the US market. In Canada, it's been mostly materials, as Rob touched on. I think golds have added or contributed about 10% of the Canadian market's return year to date. So
Right.
both markets are concentrated, but in very different ways. Yeah.
Interesting. And of course, Rob, you mentioned to valuations that we're just not comfortable paying. Like, let's talk about the other side of this mountain and what it looks like in the past where we've seen indexes get to this level of concentration of either returns or market cap, right? That
Yeah.
28% you said the top five companies. I think the top 10 companies in the S&P 500 now are up to 40% of the overall market cap.
Yeah.
What does this look like on the other side?
We would never put that much of a client's portfolio in any one sector. It's great to get caught up in speculation. Markets are speculation, but speculation should not dominate a portfolio structure.
Right.
So we have seen this before, and it's always the same. It's different players, but it's always the same. Whether it's the tech boom of 1996 to 2000, whether it was uranium stocks or housing stocks or so many different booms that we have seen, and they all seem to end the same. And it ends badly. And so we prefer to concentrate a lot more on valuation, dividends, and quality, I've been kidding Matteo about the bathtub analogy. And the bathtub analogy is this: is these things eventually do end, and they tend to end badly. It doesn't mean AI is going away. It's not. AI is going to be with us forever. And the bathtub analogy is that when that stops, the water doesn't all drain out of the tub. What it does is it sloshes to the other side. And when it sloshes to the other side, it sloshes away from those names back into the higher quality, better valuation names that we own.
Right.
Yeah, let's not forget, Jamie. I mean, going back to the Mag 7, like some of these drawdowns were horrendous, both this year and last year. Like if we look at sort of the top three being Meta, Nvidia, and Tesla, I mean, Meta's drawdown in 2022 was minus 74%. This year was about minus 34%. Nvidia's drawdown in 2022 was minus 63%. This year, minus 37%. And Tesla in 2022 was minus 73% drawdown. And this year has been about minus 50% drawdown. So these are pretty severe, pretty drastic drawdowns in, these magnificent seven names, right? Risk is what we're not comfortable with the most in those mega seven names as a portfolio. I mean, they're trading at about 32 times forward earnings. The market's about 22, 23. We're at about 22 times forward earnings in our portfolio. However, our growth rate relative to the market is about 5% better. Our earnings growth, sales growth, expectations are twice the market's. So we're trading at roughly the market's multiple, significantly below the Meg 7, but our growth rates and our sort of foundation or gas to fuel these companies is substantially higher than the market. And we're comfortable with that risk for sure.
Right. So that's just a way to say that currently the market, or however you define all the investors that combine to make these multiples, are more
Right.
willing to pay for $1 of future revenue from an AI company than they are from a regular company.
Correct.
Yeah.
Yeah.
And this isn't anything new, Jamie. In my whole career, I don't think I've ever outperformed a very narrow industry specific market. I
Right.
just haven't been willing to go there, but I've also not taken the drawdowns, and I've also done better on the other side. So I'm willing to take that trade off. If it's a year or whatever, we've still generated great returns this year. And we will preserve our capital
Right.
when the leadership of this market changes, as it always does.
Right.
Yeah, and let's not forget, I mean, the foundation of our process, which is very disciplined in terms of how we buy and sell stocks, is very much earnings driven.
Right.
And, in light of all the headlines and everything we're seeing today, earnings have been fantastic. We've had 4 quarters now of double-digit earnings growth, 13, 14, 17%. That's an extremely healthy environment. And the next 3 or 4 quarters are still pointing to about 8 or 9% earnings growth.
Yeah,
Again, that's a very healthy environment.
it is. And think of
Right.
this. Think of this. The median stock in the S&P 500 was up 5%.
Right.
So up 5% because the money was all going to essentially seven stocks. Up
Yeah.
5% in an economic environment and an earnings environment that is extremely strong. So what
Sure.
happens when the money comes out of those names, when the water in the bathtub sloshes to the other side? You would expect a pretty significant increase in the values of those companies that have kind of been left behind, because the money has to go somewhere, and
Right.
right now it's gone there, and later it will go someplace else.
Okay. So maybe that's a good uh, segue into style of the portfolio, right? So we can talk about diversification. We can talk about looking at the fundamentals of a company and its cash flows and dividends. Um, what are we doing in this market to either stick to our guns or to tweak our processes to make sure that we're still capturing the right factors?
Yeah, I mean, a lot of the work that Rob and I have done, looking back to even when, the tariffs came out, leading into that, our thought process was to try and, when we look for a company in the US or Canada, let's use the US as an example, is to really understand the source of their revenues. Where are sales coming from? And we tried to be very purposeful to make sure revenue, most of it, is coming from the US. because of the changes that were coming and because we didn't know what the impact of tariffs were going to be, we sort of, de-risked at that point. And the focus was definitely on, where's the revenue of this company coming from? And we would prefer to hold and receive most of it from the US. So keeping it very domestic, focus on valuations, focus on earnings growth. Again, we believe, over time, profitable companies that continue to grow their earnings and you're not overpaying for those earnings growth or for that earnings growth gets rewarded over time.
Right. We
Remember,
know
if we go back over 50 years, the correlation or the movement of the line of the S&P 500 and the earnings of those companies is about 96%. So that's why we believe
right.
focusing on earnings growth is a true measure of getting rewarded over time.
Yeah, and Matteo spoke a little bit about how our portfolio looks right now. We're always looking for interesting names, interesting companies to buy, and and people might think it's just a collection of companies, but it's not. It all works together in a portfolio. So we might find a company that's got great growth, and we don't mind paying a premium multiple for that growth. But at the end of the day, what we want to do with our portfolio is we want to be able to look at our portfolio and say, this portfolio has a price earnings multiple or an EV to EBITDA multiple that is in line with the market, that has better growth in the market, better sales growth, better a lot of better overall factors than the average stock. And so we're trying to build that. We're not just picking stocks. We're trying to build that so that if we have a stock that is premium multiple because it's a premium company, we've also got something that is a little more steady on the other
Right.
side, and maybe less volatile or less economically sensitive, so that at the end of the day we have a portfolio that trades at a valuation very close or even often under market valuations, but with better growth metrics.
Right.
And it has been my experience over 25 years of building portfolios this way, that even if you have a portfolio that struggles in a particular market for a particular time period, over time, those metrics always do very well and outperform the indexes. And so we understand that we have to stay with our focus and our process.
Let me pivot a little bit because we talked about tariffs and the wild ride that the tariffs. I mean, we blame the tariffs now. I think the market probably would have had a correction no matter what we blamed it on. But that's what we blame it on now. I think we have overestimated the impact of tariffs on earnings, or have we? Where we are in this market cycle seems to at least betray what we knew about going into this year with tariffs coming on and that going to be impactful against earnings.
Yeah, I hear a lot and we discuss a lot. What's going on with tariffs? Why has the market not been shell shocked from the announcement on, at the beginning of April? And I think it has to do with what we already talked about, which is earnings growth and how strong earnings have been. So as I say, the last 4 quarters, so 25 Q3, this is quarter over quarter earnings growth. I'm going to go back 4 quarters, 14.7%, 13.8%, 13.7%, 17.1%. Those are reported year over year earnings growth. That's phenomenal earnings growth year over year.
Yeah.
So has that had the impact of tariffs? I don't think so.
Yeah.
Okay, what about going forward? Because perhaps it's going to be into first or second quarter where we really start to see, the impact come through. Because think about it, when a tariff is announced, it's not on that country, it's on the company. And then the company can decide whether to take it in their margins and reduce them or pass it on to you and I as a consumer and increase prices. So even looking forward over the next several quarters, I mean, Q4 earnings growth is expected to be 6.9%. 26 Q1 is expected to be 13.1. 26 Q2 is expected to be 13.7. So the point here is that I don't think analysts have anticipated really any impact on earnings yet, and we haven't seen it yet. And we
Right.
haven't seen it on estimate revisions either, meaning if I look at what analysts as a whole were expecting for earnings on the S&P 500, and I look at how that's changed over 3 months, it's actually up about 2%. So if there was some sort of anticipation, then that number would be down, and the earnings growth that I quoted would be trending down, but that doesn't appear to be the case at all.
No, and we're, we are quantitatively driven with what we do. And our opinion on the political situation or tariffs or looking back to our economics 101 courses on how tariffs should affect things is secondary. What we're looking at is earnings expectations by individual analysts. So when we're looking at a stock, if it's a big stock in the States, for example, we might see the financial projections, earnings estimates, target prices, sales forecasts from 30 or 40 different analysts. And these guys are really granular. I mean, they talk to some companies once a week. They know their stuff. And if we are not seeing a degradation in the figures that they're supplying, then we're pretty comfortable going forward on that path.
And I'm going to go geeky on you here, but
Oh, good.
Yeah.
we
Here we
do
go.
not look at medians. We do not look at averages. We look at and focus on medians. Because as Rob said, if there's 30 men or women covering a specific stock and we have a couple of outliers, well, that's going to impact the average much more than the median. So we'll use medians in our numbers in terms of measuring rates of change.
And that's why we're still seeing, despite all of the turmoil, great earnings expectations and a median stock, the 250th stock in the S&P that's only gone up 5% so far. So
Yeah.
we think it's still a pretty good environment. It doesn't mean there's not going to be bumps along the way, but we think it's still a pretty good environment for stocks.
Great. All right. Well, finally, why don't we pivot back to Canada? Because I think we've been focusing a lot on the US and talk a little bit about the Canadian market composition and specifically its big weightings to materials, which has been driving a lot of the returns for Canada this year.
Yeah, and we have had weightings, some decent weightings in gold, for example.
Yep.
But it's never been our philosophy or style that we will. I think what materials are 30 or 35% of the index right now. We are never going to put 35% of our client portfolio in materials. We're absolutely not, because we've seen both sides of it. We need to maintain diversified portfolios, and in Canada we get the big advantage of also buying dividends, and we will buy dividends when we can. Dividends are extremely underappreciated by most investors as to how much of the overall return they do furnish, and so we are very focused on that as well. But we will never get into any one sector to the extent that it might be weighted in the index. Back in, I think at the height of 2000, Bell still owned their position in Nortel.
Mm-hmm.
And Nortel was an individual stock, of course. And the markets, I remember driving home, listening to 680 News, and they would say the TSX was up so much, the Dow Jones was up so much, and Nortel was up so much.
Right.
When stocks start becoming their own asset class, you need to get worried. And Nortel and Bell, I believe, were something like 48% of the total weight of the TSX.
Yeah, Nortel alone was 35.
Yeah, and together they were 48. We absolutely cannot do that, and so we will maintain a diversified portfolio. By the way, when those things started melting down, the market did very badly, but Canada Bread did fine. Power Corporation did fine. We found that the water in the bathtub started sloshing back over to the value names, and it's where we're always positioned.
Yeah.
Okay. And maybe you can just, with respect to materials, and I'll combine materials and energy into one sector and call it stuff you pull out of the ground. Those companies are going to look the best on paper when whatever they're selling is priced at the highest, but we know that material or oil or gas or whatever it is very cyclical.
Right.
Yep, absolutely.
Right.
And it's a different animal, because we can look at an industrial company and we can say, well, this is how many widgets the average analyst on the street thinks that they're going to sell next year, with things that get pulled out of the ground. You now have to make a second guess and say, and what is the price of that commodity going to be?
Exactly.
Right.
And we had 3 years there in the late 2018 to 20 where oil did nothing, went
Right.
absolutely nowhere, and so
Even recall it went
we
negative in 2020. Like oil
That's right.
actually went to zero
Yeah.
for a brief
Yeah.
few seconds,
Yeah.
but it did.
yes, it did, and we would prefer to make a decision based on things we can touch and feel, rather than what world event might cause the price of gold or oil or copper to all of a sudden go up sharply or down sharply, and that's a very hard thing to do.
Yeah, I guess the answer to your question, Jamie, really comes back to the foundation of what we do, which is earnings based, earnings focused. And if the volatility of those earnings is extreme, then we're probably not going to own something to that regard. Yeah.
Right. And so to the extent that we do have materials and energy companies in the portfolio, which we do, we
Yeah,
can also say that those are steady businesses that have a great history
absolutely.
of making money and paying dividends. Or
Yeah.
not necessarily dividends, but continuing to show good fundamentals.
And larger, probably larger cap in terms of their
Right.
overall size. So bigger, much more stable cash flows for sure.
Right. Well, guys, this has been really helpful. Do you have any final words as we finish out 2025? Or you guys have any comments for us as we close out the year?
No, it's just we've seen all this before,
Yeah.
and we know how to manage through all of this. So it's a little bit frustrating to see one U.S. technology stock go up by 50% because their earnings, they beat earnings by 2%, and then another one take their place and they go up 50%. But we know that our process is extremely solid. We know that in the long run it works, and so we have no concerns at all about the market over the last year, and we feel very good about the economic picture going forward.
Thanks very much for joining me, guys, and
Okay,
we'll look
Jamie.
forward to seeing you next time.
Thanks,
Okay,
Jamie.
thank you.
Take care.
All right.